Hello everybody and welcome to the first Captive Review webinar of 2023. My name is Nick Morgan and I'm the publisher of Captive Review. Today I'm really pleased to have Zurich Insurance as our hosts for this webinar, and we're going to be exploring the benefits of group captives, something which has long been standing in the US and there seems to be increasing interest in the European market, and I'm really excited to hear what the team have to say over the next hour. We encourage you all to ask questions, so we use a very simple system, and you can see on the slide there we use Slido as our question master, so it's slido.com and then just put in the hashtag Captive Review. And I'd just like to see pop up on screen Emma. Welcome. Emma is the Global Head of Captives at Zurich Insurance. Welcome, Emma. How are you?
I'm good, thank you.
Great.
And thanks to all of you for joining us on this webinar about group captives. We hope you'll find it informative and insightful. So my name is Emma Sansom and I head up Zurich's Central Captive Service team based in Zurich. And I'm responsible for developing Zurich's global captive proposition, specialising in innovative and sustainable fronting and ART solutions across life and non-life. Today, we're going to be talking about group captives, and I'd like to spend a few minutes giving some context around the discussion that we're going to have over the course of the next hour. So the format of the agenda will be a panel discussion, supplemented with slides, and these will be shared after the webinar with all attendees by email, and also uploaded into the Captive Review's virtual series website. And we'll be leaving 10 minutes at the end for questions, so do pop your questions into Slido. For the purposes of this discussion, we'll be assuming a base level of understanding of cell and pure captives, but if you would like to know more about captives in general, you can get in touch with any of us, and there is also a captive guide available on Zurich's website which provides an overview of captive basics. So captives were once a mainstay of very large corporates, but they're fast becoming more accessible and mainstream risk financing solution to smaller organisations, partly due to the rise in more cost-effective cell captive structures, an increasing awareness of their benefits within the insurance market itself, and better data available to risk managers, enabling informed decisions around managing a whole portfolio of risk. In terms of group captives, there's a booming market already in the US. Zurich's group captive unit alone manages more than 45 programs with over 3,200 member companies in North America across a wide range of industry segments. And according to a recent report from the Insurance Information Institute and Captive Resources, organisations that participate in group captives suffer 48% fewer fatalities, 39 fewer lost time claims, and 22% fewer workers' comp claims overall. But despite this, in Europe, the take-up has not been quite as pronounced. We hear a lot about cell captives and pure captives, but not so much about group captives. There have historically been a number of notable and successful risk-sharing structures in Europe. However, in the past 15 years, there's been very little growth activity in this space. That said, in the past year or so, this trend does seem to be potentially turning somewhat, as the hard market has meant that risk managers are seeking alternative solutions in order to finance risk, as seen in the example of MyRisk, which is a captive mutual risk-sharing vehicle incorporated out of Belgium. Whilst ultimately a group captive is not going to be the right solution for everyone, for like-minded organisations with high standards of risk management built into their DNA, a group captive could provide an appealing solution to a number of challenges. And that's why we're here today. We see the benefit that this type of structure could bring. So we aim to at least begin to decode group captives, provide an understanding of what they are and their benefits, understand the success that has been had in the US, and explore what a European solution could look like, whilst also considering the challenges that setting up a group captive will entail, as with setting up any captive. So if we could go to the next slide, I will introduce our panel. So Dawn Highstand serves as Executive Vice President and Head of Group Captives for Zurich North America. Dawn's responsible for the overall underwriting strategy and operational management of Zurich North America's group captive insurance business, which includes member-owned, agency and fronted captives. Joshua Nyberry is Head of Captive Fronting for Zurich in Europe and also supports the fronting managers in the APAC and LATAM regions. Before that, and after various roles in PwC and Deloitte, Joshua took up the role of Captive Insurance Manager in the Cayman Islands, where he specialised in group captives for US member companies. Jeff Matney serves as Senior Vice President for Sales for Innovative Captive Strategies, Inc. And these are a team of captive consultants responsible for educating new captive members and is focused on bringing quality companies into the existing member-owned group captives, as well as leading group captive startup initiatives with a strong focus on homogenous construction captives. And last but no means least, Oliver Schofield is CEO and Managing Partner at Risks CWC. His particular focus has been the incorporation and reinsurance of captives, cell captives, association captives, and a myriad of ART structures for a range of different industries from across the world. He's worked with some of the industry's largest pure and cell captives, largest broker-owned captives, and leading industry captives. So I think it's fair to say that we're in some very good company. So on to the main discussion. Dawn, can you kick us off by giving us an overview of how a group captive operates and how it's different and similar to a sole or single parent captive?
Yes, absolutely. So thank you, Emma, very much for the introduction, and looking forward to having this discussion today. So I know that we had started the discussion to say we think that everyone maybe who's attending here has at least some sort of foundational understanding of a single parent captive structure or a cell captive structure, but I thought it might be a good idea just to make sure that we kind of have the clear understanding on the distinction, because they are in fact separate and distinct before we get into the group captive definition. So when we think about that single parent captive, it really is a captive that's owned and controlled by a single entity. It's established to provide insurance coverage for the risks that are faced by that parent company, but also its specific subsidiaries. So the captive itself acts as the reinsurer, allowing the parent company to retain the risks within its own structure instead of relying solely on the traditional insurance market. So it can underwrite various lines of insurance, and this will become important as we transition to the group captive conversation as well. So they can write risks around property, liability, cyber, or employee benefits. And they really are utilized by large companies that have significant insurance portfolios and really resources to finance a fully owned reinsurance subsidiary. So if you will, they own full control of their insurance portfolio. When we talk about a protective cell captive, it really involves the creation of separate and distinct cells within a larger captive structure. So each cell operates an independent insurance entity. They're legally separated from the other cells and in fact the core captive. So the cell captive is often owned by a sponsor or a core company, and the participants basically occupy individual cells and they maintain separate accounts. The assets and liability of each cell are isolated from each other. And again, this will become important when we talk about the group captive structure. So the ownership, if you will, is basically has rules of residency, and they really, to occupy that cell, pay certain costs and fees to occupy it. Sometimes this is viewed as a stepping stone, depending on the size of the company, to forming a single parent captive. So now, what makes that particular structure a bit more distinct than the group captive? So a group captive is really a vehicle that allows various related or unrelated businesses to come together and form a collective insurance company. They managing select portions of their risks. So while small and mid-sized businesses often lack the scale and resources to form a single parent captive, they can enjoy many of the same benefits by joining forces with other companies, which they have, again, maybe some affinities with or similar business segments. So for instance, construction, which I know we'll probably talk about a little bit today. But the participation in that group captive really allows members greater oversight of all facets of their insurance programs, cost savings, as well as the benefit of shared investment income. So member-owned group captives are wholly owned and controlled by the participants, and they only insure the member companies that own that particular captive. Emma, I think you might be on mute.
I am on mute. Oh, I think I need to put a pound in the charity jar there. Sorry about that.
Yeah, no problem.
So the question I was asking was, what are the considerations for companies wanting to set up a captive or join an existing captive?
Yeah, so, and I'm gonna, I know my colleague Jeff will be able to inform individuals on this call on the real specifics around it, but there are some distinctions that individuals need to consider and member companies need to consider before looking at a group captive structure. The first is really the difference that we see in the captives distribution model and the means in which you start to investigate this as an option. So what hopefully our participants can see here is there is some distinction in that distribution model. In our traditional property and casualty market, what we often start with is a customer or an insured who is looking to place their insurance coverage. They go to a retail agent or a broker, and then that broker will come to an insurer that they have relationships with to place their insurance portfolio. In a group captive structure, one of the considerations is actually associating and contacting one of the main players in the group captive space, which is the captive consultant. And again, that's where Jeff will be able to explain a little bit more detail about their role. But it's the same. The insured comes to their retail agent or broker. They're looking for an insurance solution, but that broker then would associate themselves with a captive consultant who would then provide guidance as to what is the proper group captive that this entry or a member company will want to enter into. Does it require actually a new group captive to be formed? And then they associate and approach the insurer or fronting carrier in this particular model. And then if we go to the other slide or the next slide, it actually is further identifying some of the other considerations that we would want to look at. So really what this does is the group captive structure really allows all of the different services that an insured or member company may be looking for, but it capitalizes on multiple players in the insurance value chain, if you will. So when we talk about the marketing and distribution around the setting up of a group captive, that's where our captive consultant comes in and also our broker. But your fronting carrier can serve in a variety of different options as well. So really the group captive still relies upon expertise and service carriers that they bring in to help service that group captive. So a fronting carrier can own anything from underwriting to policy issuance and servicing, sometimes involved in loss control and also claims. However, there are also opportunities, particularly in loss control and claims, to be having other service providers come in, and some of those may be third-party administrators or others in the organization. So again, the members of the group captive ultimately get everything that they would if they were standing on their own, but the group captive allows them all to share the services that come together, and that captive consultant is really the one who provides the service to bring all of those things together and really what we believe to be the best in class relative to service carriers to provide services to the group captive.
So just building on what Dawn has said, Jeff, what is the role of the captive consultant in this value chain?
Yeah, thank you for having me. I appreciate it. Really, the role of the consultant, as Dawn touched on, we operate basically as the back room of the captive insurance company. So we set up, market, and manage group captives. So everything from doing the business plan to establish the captive, establishing the license, and then working with a national network of brokers around the U.S. to help grow the captive with individual captive members. So our team's made up of underwriting professionals, program managers, finance, investment, risk management, claims, event planning, everything to help the captive members, the shareholders of the captive, run a successful reinsurance company for them. Obviously, they have to run, these are talented business people, talented leaders, very successful in what they do individually and in their industries. They don't necessarily have the insurance expertise to run an insurance company, so that's really what our team does, is run the day-to-day, consult with the board, and help them run a profitable insurance company.
Okay, thanks for that. And just moving to sort of the growth that we've seen Tell us a bit more about that journey to such fantastic success for group captives. Why do you think there has been so much growth?
It's been consistent growth really since the mid 80s when this current group captive model was really innovated. But it really comes down to value. So you're working with the group captive really brought the captive model down into a smaller segment of business owners. So what we call the middle market, to where from a premium standpoint, roughly $300,000 in premium for workers' compensation, commercial general liability, and auto. It really is the entry size, and then from there, there's really no ceiling from that standpoint. But because of that, it really opened up a whole different market, and the value the captive member gets out of it. So they're generally privately owned, family owned, or closely held businesses, and the premium expense is generally one of their top annual expenses, top 3 line item of expense. So what it allows them to do is, one, take control of that cost by owning a portion of the insurance company with taking so much risk for so much reward, but it turns it into, as opposed to just purchasing premium for an annual period, it turns it into more of a long-term business strategy where they have the stability of being insulated from the traditional market. So when the marketplace swings, premiums go up or down, they're insulated from that. They have the control really from establishing rates based upon their individual 5-year performance through an independent actuary. And so going forward, they kind of dictate their rates through performance. So even how they focus on risk management is different. And then really the opportunity. So the financial opportunity to earn underwriting profit plus investment income on their premium dollars. And the one part, if you really talk to captive owners who've been doing it for a while, there's that operational improvement that comes along with it. When they become part of a peer group of like-minded, successful business owners who are, basically trying to row the boat the same way, it's amazing how much better they make each other and help each other out through different business challenges and that kind of thing. So when you talk to a captive owner, it's pretty interesting. They'll mention the financial aspects of it, but a lot of times they'll talk about the operational improvement, how it helped them become a better company. So it really just comes down to value, and each business owner that joins a captive may join for different reasons that they're attracted to, but ultimately it's the whole value through the value the individual member gets through the value chain that's pretty amazing. As far as
speaking again, oh sorry,
I was going to say on the broker side, another reason for the growth. From a broker standpoint, one, it's great business. So, I mean, these are the ideal clients to have because they're thinking long-term and they don't switch relationships a lot. They're not shopping insurance every year. So it's great business, and it's the retention within a captive. So once a member joins, the retention of a member staying in the captive is 98 to 99% annually. So you rarely lose a client. Because, like I said, they're thinking long-term versus annual renewal, and that's a key distinction. So retention-wise, it allows them to, insulate key clients, but also for those brokers in the U.S. that have grasped the concept, the captive concept, and proactively used it in the marketplace. It's been an enormous new business tool to help them grow their individual books as well as their brokerage and agency services. So it's really the value chain all the way through that the group captive provides for the captive member as well as the retail broker that has really made the growth really accelerate.
Yes, and it seems like the distribution channel is extremely important in that. And why do you think that is?
Well, as Dawn said, that the broker has the relationship with the clients we need and that the captive wants to grow with. So you have to have a very strong national network of brokers who are educated on captives and view it as valuable to them as well as their clients. Otherwise, going direct, it would be very, very challenging because you'd have to break long-term relationships at the broker level, every time you're looking for a captive member. So they really are the lifeblood of the growth of the captive.
Thank you. And just moving over to the European market, given what we've just seen in relation to the US, Ollie, how does the EU market differ? And do you see any opportunities for risk sharing?
Thank you, Emma. The European market is very different. First of all, from the point of view of its maturity levels. Certainly the penetration that we're seeing in North America is not replicated in Europe in terms of the volume. There are some vehicles, you mentioned Myras earlier on in the conversation, and there are one or two others that have been established in Europe over the years, but you are literally counting the numbers on the fingers of two hands. And in a way that then brings a second challenge, which is awareness and knowledge about the how-to. How do you go about identifying industries that might lend themselves towards a group captive solution? How do you then go about corralling all of those particular industries and building the solution? And also, how do you articulate the benefits that have been clearly shown from other panelists so far this afternoon, articulating those benefits across the European region? And then, of course, that comes to the level of experience that there is in the practitioners and the potential buyers. We've all been talking about captives, single parent group, PCCs, etc., for many, many years, and Europe has its good share of a number of those vehicles. But I suppose one of the big barriers that we've seen, we'll talk about barriers in more detail in a moment, but one of the challenges that we've seen is building the trust between organizations that are effectively competitors, not just in their own country, but across a very broad geographic and regulatorily different region. Now, having said that, it is possible and it can be done, and I would absolutely advocate and encourage companies based in the EU environment to move ahead and start exploring these vehicles.
Absolutely, and I mean, you therefore see opportunities, but what are the barriers, do you think, that you see putting people off?
Well, yes, just sorry to carry on in the opportunities for a while. I mean, there are great opportunities, and particularly if you look at the unstable times that we're having, not just in Europe, but all around the world. I feel quite strongly that group captives can absolutely bring an element of stability, an element of certainty and flexibility to the insurance purchasing of corporations around the EU. So yes, absolutely, there are opportunities, and why not? Why not go ahead and do this? Which actually then comes to the barriers. And I think I've got a slide on this a little bit further in the deck, if we can move forward.
Could we get the next slide, please? Thank you.
And the next. One more. That's it. So the barrier, back one. The barriers are very much about finding a design.
Let's go back to.
Yeah, we can flip back a couple.
Yeah, there we go. That's the one.
There we go. It's finding a desire and a need for collective problem solving. Many companies are understandably very fierce about protecting their confidentiality and don't want to open up their way of doing things to organizations that are effectively their competitors, if we're looking at an industry captive or a group captive that is focusing on a specific industry. So the first thing that we need to do is to try and build a community of trust across those organizations. And that's not an easy thing to do. Trying to get 15 or 20 different companies who are inherently competitors into the same room, be it virtual or physical, to even start talking about the idea of sharing knowledge is a big barrier. From that, though, if we can get over that one, we then need to create a community of interest. So we built the trust. Now let's identify where those shared interests are, because some operators in a particular industry might think that property insurance is the big problem. Others might consider it to be the casualty liability insurances. So you've got to find that common ground, that community of interest. And once you've done that, you then need to find a community of cooperation. So you now trust everybody, you have a shared interest, but are you going to cooperate with everybody? And that cooperation means opening up aspects of moving into the risk management side, looking at the sharing of data looking at some of the technical parameters that surround the idea of the risks that are in hand. In some industries, we would need to look at finding a consensus on the various standards that are being deployed across risk management, but also across the activities of those particular companies, and building some kind of consistent approach to risk management, loss mitigation, loss prevention, etc. And I imagine that most of the audience are listening there thinking, goodness me, that's a huge thing to do. But it is incredibly important to be able to do that. And quality assurance is another one that is on that risk management box there. The biggest fear that members of a group captive have is where there is a mutualization of risk, because everybody thinks they've got the best risk in the world. And of course, if I've got the best risk in the world, why do I want to jump into a pool with people who I don't think have got quite the same approach to quality risk management? Because I might end up having to pay their losses, which is a complicated conversation to have with my finance director when my premiums go up, or I have to make an extra contribution to the fund because our competitor has had a problem. So these are very real and very big barriers that have to be overcome. I think another barrier is the time that it takes. Now, we all know that to set up a cell, some domiciles will tell us it can be done in 24 hours. I've not come across that yet, because of course one of the biggest barriers in that part of the world, any part of the world, is setting up a bank account, and bank accounts can take 2 or 3 months. But parking that for a moment, they say it can be done in 24 hours. Group captives, in the environment in which we're talking about in Europe, you've got to be allowing somewhere between 12 and 24 months. Now, that's a huge time commitment. And why did it take so long? Well, because you go back to box number 1 there, getting people into the same room to even start talking, and then deliberating, and then coming up with agreeing the risk management protocols and so on. That takes time. It takes a huge amount of time. And of course, you then get a little bit of fatigue. And people say, well, do I really want to spend the next 12, 18, 24 months setting something up? I've got renewals to deal with. I've got my day job to deal with. So it's an inertia barrier. We have come across some companies, particularly in the UK, worrying about anti-competition concerns. And we all know that the Competition Markets Authority in the UK and the equivalent across the whole of the EU look very carefully, perhaps too carefully one could say, at the way that anti-competitive practices are potentially perceived. So we've had some of our clients saying to us, are we actually allowed to do this? Is this not going to be considered to be an exclusive cartel, an exclusive club that only selects certain members? Is that not in itself anti-competitive? So again, another big barrier that needs to be overturned. And I think the final one, and again this is very specific to the EU, is that we have the cross-border challenges. In that you're looking at members from many different countries that each have their own legal system and their own insurance regulations, which are somewhat harmonized by being members of the EU, of course, but the EU isn't the whole of Europe. And so then you start thinking about other European countries who might have companies that want to be part of a pan-European industry group captive, and then you have to consider all of those aspects as well. I'm not going to include language as a barrier, because I feel quite passionately that if you're working on a multinational basis, you should be able to talk more than one language if you're involved in that type of environment. So we can get over the language side. But there are barriers, and going back to what Jeff was saying about the role of the consultant, I think the role of the consultant here becomes so critically important to ensure that they can navigate the potential members of such a group safely and effectively through all of these challenges.
Thanks. And I have to say, I think I might be contributing to some of that barrier challenge with the language. But can you maybe share some success stories that you've seen with us?
Yeah, if we flip onto the next slide, I think what we're showing on the next slide is, thank you, a list of some notable group captives in history. And I imagine that most of these names will be familiar to the panel, and I'm sure also to some of the audience. What's very striking about this slide is the number of group captives that were set up outside of the UK and Europe. They're pretty much all Bermuda or USA from the point of view of the very large group industry captives. From an EU perspective, there are some success stories, and I suppose Imani is the big European success story. It was set up nearly 30 years ago as a result of there being a lack of capacity in the traditional insurance markets for the nuclear property industry. And it's had a very successful underwriting history, and now has more than 250 billion euros of assets, according to the website. So that is a huge success story. I think you could also consider Phil or Pharmaceutical Insurance Limited to be a success story. Again, it was set up because products liability cover for global pharma companies was very hard to come by at that time. And it lasted for a good 10 years. It closed down because the market moved on and the members' desires and aspirations moved on. But it filled a gap at a very important time in the European pharmaceutical sector. I sincerely hope that Maris will be another resounding success as it builds. But these are all good examples of collective problem solving, where the like-minded individuals and companies come together to find that solution. And I suppose others that could be considered a success, I show Wren there as one of the architectural mutual in the UK, but there have also been various defence unions that have been set up across the medical profession in the UK and Ireland, where the physicians and surgeons have been looking to buy cover outside of the traditional insurance market. So there have been successes. And the current pipeline, certainly from companies that we're talking to across the EU space, European space, there is interest, and those companies are appreciating the effort, the time and energy that needs to go into it. But I think all of us have the challenge that we should accept with open arms of trying to convert that interest into tangible demand, and that's what I'd like to see in the coming years.
Yeah, I think that's certainly the challenge in hand, isn't it? So I'm just going to take a quick pause and just remind everyone that Slido is there. We've got some questions coming through now, which we'll address at the end of this section. So yeah, do send them through. So Josh, just turning to an insurer perspective, where do you think an insurance carrier can actually add benefit in this value chain?
Thank you, Emma. When you look at captive owners, irrespective of the setup, be they single parent captives, group captives, or PCCs, they have to manage an increasingly complex environment, and this is driven both by regulation and market characteristics themselves. This drives the needs and expectations that the insurance carrier as a partner must meet. And here is where the insurance carrier actually adds the greatest benefit to group captive members. So I would like to speak to three broad categories that an insurance carrier brings to a group captive. The first is program implementation. If you could move to the next slide, please. I think yes. This is the most obvious contribution that an actual program needs to be implemented. And here you need a fronting carrier. By design, group captives are lean entities without a fully fledged underwriting or claims function. The captive members on the other side need policies that are issued by a licensed or admitted carrier, but the group captive will often not have the infrastructure or the capabilities to handle primary policy issuance and ongoing servicing. Therefore, the insurance carrier ensures that the program is implemented across multiple jurisdictions in a compliant way. As Oliver mentioned, not the entire Europe is in the EU. So there's a point where you have to go into different jurisdictions and you have to still issue policies to those members of a group captive and find those policies into the group captive itself. The other aspect of program implementation, as we can see on the diagram here, is the centralized pooling of the risks. And this enables a basket of risks from all the individual group members to be transferred to the group captive in a single transaction. And an effective and professional, of course, a fronting partner should be able to simplify issuance of the insurance policies across multiple lines of businesses. Some group captives are having a single risk in them, which could be motor. Others could only have maybe property, but others have a set of risks which they write for their members. And therefore, all this needs to be simplified for the group captive because they do not have the infrastructure to manage such a huge set of risks and be able to get them into their own P&L in a way that is simple and effective. But over and above these basic operational aspects, you realize that group captive members may require unique coverages which are outside the captive itself. This is the case where the captive members have exposures which go above the captive's own catastrophic potential. Here, often we talk about the arranging of umbrella coverages. And knowing that not all members in a group captive are the same, one will have assets and exposure that are way higher than another. These umbrella coverages offer the flexibility to get your own coverage to cover the exposures that you are facing. A fronting carrier is instrumental, of course, working together with a consultant in ensuring that these can be put in place. The second category of benefit really is the operational efficiency, and I have alluded to that already. If you think about it, the technology to deliver accurate, transparent, and timely program data for reporting to stakeholders or the captive itself and other decision makers is often supported largely to a large extent by the systems which are run by the fronting carrier. And then this information is fed into the captive manager can then split it into the individual member details for their own financial accounting. But there's a lot that rests on the systems and technologies that the fronting carrier has. The last one that I want to mention here, if you think about captives generally, the creation and operation of a captive is a journey. And so a group captive will go through processes from early stage, mid stage, and finally into maturity. And even as Phil mentioned, Oliver mentioned, there's this captive called field that eventually closed down. You find that when a group captive matures, the insurance carrier can step in to help close the old underwriting years. And this then enables the group captive to redeem the old inactive members or to actually close down. This happens through commutations, where the insurer assumes the captive's remaining historical liabilities and then terminates all the reinsurance contracts of the captive. There's an additional benefit that this also brings, and this is the release of historical collateral. Because for every set of reserves that you may be having, and the fronting carrier also has to reflect reserves on their P&L, you have to provide collateral. Through commutations, this gets released, and then the group captive members can be redeemed, or the collateral itself can be released, and the captive can seek, maybe have more capacity to write additional risks.
Okay, thanks for that overview. And to that end, how could a group captive be structured into a program?
So each group captive will have the flexibility really to structure their program according to the member needs, and the consultant will have quite a big say in this case. However, we know of some two fundamental aspects in any program design. The first one is program structure, and then the other one is around premium determination. With respect to program structure, we often see three main layers in how the risk is actually arranged and how different players in the process attach. The first one is the captive retention layer. This is the set of risks which actually go into the captive's own P&L. Each member of the group captive will have what is a dedicated loss fund. And within these, they pay their own frequency claims. And in cases where there's loss sharing, they could take on the losses of other members. Any money which is not spent within the captive retention layer builds the equity of each member, and at some point, this could be returned as a dividend. Above the captive retention layer, if we could move to the next slide, please. I think the delay. Yes, thank you. And then above the captive retention layer, we have the specific reinsurance layer. This is where the captive actually purchases reinsurance coverages for all the risks which go above the captive retention. So assume a case where the group captive retains the first 150 and a member has a loss which is 600,000. If this captive had a reinsurance layer which is up to 1 million, the 450 that sits above the captive retention of 150 in this example that I've given will actually go into the specific reinsurance layer. This will be taken most of the time by the front carrier, because this is really conventional risk transfer above the captive. The third one is umbrella coverage. And as we said, not all members are equal. One member will have a factory, say, that is worth 10 million. One will have a factory which is worth 2 million. Yet within the captive, all retain 150 or 250. How do you then ensure that a member with higher exposure gets the right coverage so that they don't have underinsurance? The umbrella cover above the specific reinsurance layer addresses this. There's a lot more flexibility for each member to arrange coverage which meets their needs. And on an overall basis, this is how a group member comes up and ensures that their own assets, while they participate in the group, they can get a full tower which covers the risk that they're facing. Now, with regard to premium calculation, this is an interesting one. The premiums that a member pays ought to reflect their own exposure and their own experience. And this is important because if you're coming together as best-in-class partners, someone has to understand that from your risk profile, you do not pose a higher potential of causing losses to the other members. And therefore, once they've looked at your own experience and your own risk profile, of course, you get admitted into the captive. They then model the premiums you're meant to pay. One member will pay a different premium in total than you, but each of the premiums you pay individually reflect the potential that you can cover first your own losses based on the experience, plus of course some additional experience adjustments, which is often referred to as additional assessments. This can happen maybe after the years have been underwritten and the years are old. As your experience develops, they realize that what you paid in was not sufficient. You get an additional assessment to first of all cover your own losses before other members can help you in case you really exhausted your own loss fund. But this way of determining premium is anchored in the founding tenets. For a profitable and sustainable group captive, you have to bring in like-minded and best-in-class partners so that even if you are competitors in the industry, you become partners in risk management. And the safer you are, maybe the lower the premiums you pay, but most importantly, the safer your partners in the group captives are. And this is quite critical in building a community of trust. This is the only way a member joins and stays in the group captive for the next 10, 15 years with other members in it. Otherwise, then they become inactive, they start exiting and being redeemed out of the group captive.
Okay, so thanks for that. That's been very interesting. Now, we've got some questions coming through, so keep them coming. We've got a couple that are quite similar, so hopefully we cover off the main topics that have come through. Obviously, if we haven't answered your questions or you want to talk to us separately, we are available after this webinar. Do reach out to us. We'll be sending the pack round, so you'll be able to see the buyers and everyone that's taken part today. So the first question, I'm going to pass it over to Dawn. So are group captives used to diversify risk, or are they usually similar risks and industries, i.e. do they insure different risks to get diversification benefits?
Yeah, so when we're talking about the group captive model in the US, the risks are fairly similar in the types of coverages that they're looking for. So again, in the US based model, the risks that typically fall into the group captive and frankly make it very successful is by writing workers' compensation coverage, auto liability, general liability, and within the auto coverage, there is sometimes auto property damage covered that is sought as well. So the underlying risks of coverage that the members are looking to put into the group captive are typically those in the US model. Now, when we talk about diversification, though, there is diversification that we look at relative to the industries that are coming into any group captive as well, because along with portfolio mix on your risk exposures, you also want to look at your industry mix as well. So that's where also when we talk about the US group captive model, there are really two types that can be formed. One is a homogeneous group captive, which would be, again, like-minded companies coming together, but those that are in the same industry. So we could use construction as an example of that. So a construction captive coming together and members coming together in order to manage their risk. Equally, we have one that is called a heterogeneous group captive, which is really different industries that are coming together and still wanting to gain the benefits of their risk insurance profile and their risk insurance management. However, they are coming together and deciding to assume risk across different industry types. But at the core, they still are in a position where they want to share best practices in terms of what is working in their particular industry. And we find that other member companies in different industries are able to capitalize on that knowledge and in some instances be able to utilize it in their own risk management practices.
And again, I'll just throw that open to the panelists if anyone's got anything to add to that. Otherwise, I can move on to.
I think it's very good examples that Dawn gives on the homogeneous and heterogeneous captives. And you know, if you think back to the 80s, ACE and XL that was set up then initially were effectively group captives, and they focused on providing a particular cover to companies from a whole range of different industries. But then when you look at Imani, Track, Rail, they were arranged in setting up casualty liability or property cover for a group of companies from the same industries. So really, it depends on what the biggest challenge is as to whether they become homogeneous or heterogeneous. But wonderfully, our world is so flexible when it comes to alternative solutions that both can be catered for.
And one comment on the spread of risk. So even in the homogeneous captive like construction, so we have the geographic spread of risk, obviously by line of insurance spread of risk, where we keep it fairly heavy on the comp side, lower on the general liability and auto liability side. But even within that, we use different types of contractors. So, you know, a street and road contractor, which is a horizontal contractor versus a vertical contractor, you spread the risk even within the homogeneous groups as well. And to touch on one of Oliver's comments earlier about the competitive nature of the members, within the construction trades, we run into that all the time. And it's a very popular industry for group captives. But there is no proprietary information shared member to member, no financial information, no premium rates, anything that's proprietary to that individual member. And so because of that, a lot of times that trust is built where as long as they're friendly competitors, they respect each other as business owners. We do have competitors in captives together. Now, there are times, to Oliver's point, where that does not work. So you can't put them in a captive together, but we definitely deal with that dynamic as well.
Thanks for that. Now we've got another question coming in. Ollie, I'm going to direct this to you initially, but you know, as I said, do feel free to jump in. Is a silo captive not better as you have separate legal structure, so less risks for members than a group captive where that separation is not there?
It's a fascinating question. I think it's not so much a better or worse situation, it's more what is going to be the best approach for the needs of the particular clients. I mean, looking at that slide that fortuitously still on the screen, Joshua was showing the various different deductibles and then the group purchase of reinsurance. Now, that portfolio effect of buying the reinsurance as a group captive is more than likely going to get you a better deal because you're dealing with a much bigger premium volume. And therefore the market will be much more interested in providing that type of cover, one hopes, but specifically from a breadth of cover and also from a price perspective, because you're dealing with volumes, you're dealing with a much larger portfolio. With the single captive structure, I can see why that works so effectively in the US, albeit that I appreciate it's made up of many, many different states and different regulations within those states, but you know, it is one country effectively. Whereas a single captive structure in the European environment, you get far many more complications when it comes to the regulatory environments in which it's being established. So to have one overall group captive where all the members are owners and participants is often a more straightforward way of doing it. But I will just add one final comment on that, which is we are seeing a move away from the mutualization of risk, but so we have the mutualization of knowledge, of concepts, of ideas, of best practices, and indeed of the costs of the establishment and the ongoing operational fees that are required. But moving away from the mutualization of risk, so you don't have that conversation I mentioned earlier, whereby you have to go to the finance director and say, this other company's just had a real problem, and now we're in the mud as well. And that's something that I know is gaining much more traction and more interest.
Okay, let's move on to the next question. And Jeff, I'm going to direct this at you, but you know, open to the panel as well. The key to make captive sustainable is loss control. How is technology a part of that, and how do you see the budgeting of technology? So I think that might be two questions in one there, but I'll hand it over to you, Jeff.
Well, I think everyone would agree risk management is really the backbone that drives success when you're taking risk, whether you're, you know, Zurich or you're a private reinsurance company with the members. So risk management is really what it starts. So they plug into a risk management platform. It's all about going from being a compliance-based company to be a learning organization. And so there's very robust programs built around the captive. And I think that's one of the reasons we talk about value. When a member becomes a member of a group captive, the resources that they have access to, not just from the carrier side, which is robust, but also the captive builds programs specifically for its members, because you're part of a much larger placement in the marketplace versus an individual placement. And so risk management really is the backbone. As far as the technology piece of it, there's a lot of emerging technology when it comes to risk management. It's been slow to be embraced, but it's being, I would say, tested in a lot of areas. But the technology piece is definitely coming down the pipeline, and there's a lot of insurtech that's being tested in the marketplace right now.
Yeah, and I would agree with Jeff just relative to the technology. I think as it's introduced, there is some testing that's going on, I think, you know, among our customers and members. Again, if we start with the premise, and I think we should, that these are really best-in-class companies that are coming together to form an insurance program together, and they believe that they are all dedicated to that. They are going to look at some of those technology investments, and ultimately the return is taking care of their risks at the forefront, so risk mitigation, to avoid what they would be experiencing loss on the back end. So really that, you know, loss containment as well. So if you have that technology available, ultimately less loss, ultimately then less risk sharing, ultimately less premiums being paid. So that technology piece, I think, is going to continue to be looked at, whether that is, you know, from employees and keeping them safe, and making sure that they continue to be safe, and also in terms of, you know, whether that's technology that's being utilized now in fleets or in autos in order to help signify to a driver when they may be, distracted in their driving. And frankly, some of the technology is helping on the loss containment side, because if an accident happens, there is potentially video, right, and technology there to show exactly what happened, when it happened, and who may or may not be in fault. So I do think we'll see an increase in it, but to Jeff's point, it's a little bit of a slow uptake, but I do think that we'll continue to see that being utilized.
And I think we've got another question coming, which is sort of related to that risk management piece. How easy is it to remove a member if you feel their standards are slipping below that of the group, or they simply become too much of a risk? And I think that's one.
If I draw on my experience, the time I was involved in group captive management, the board of directors meets maybe twice a year. There's a risk committee. Group captives are run through committee structures. And the risk committee looks at each member's risk score. And they always keep you on a watch list. And when you're put on a watch list, you have a certain period within which to remedy the points or the triggers that got you on that watch list. It becomes the basis of sometimes renewal. Then you may be non-renewed because your risk profile is worsening and then you're not responding to it, keeping in mind that because of risk sharing, you want the best-in-class partner. So if you somehow got in and your situation deteriorates without any remedial action on your side, you essentially get non-renewed. But no, typically this doesn't happen on a regular basis.
And I think that's a great answer, because it also addresses some of the anti-competition concerns that we've been discussing over here, which is, the group captive has the right to decline to renew cover. So it's not a price fixing cartel by any stretch of the imagination if you have that right to say, no, you no longer are fit for the purposes of this insurance market that we've created. Just like any other insurance market out there, they have the right for non-renewal.
Right, so we do have some more questions that have come through, but we're running out of time. So what I would propose is that we, as we follow up on this with sending out slides, we can maybe answer some of those questions as we do that. Before I close, I just wanted to go around very quickly to the participants and just ask if there's one piece of advice that you give in one sentence, what would it be? And so we'll go to, in no particular order, we'll go to Ollie first.
Thanks, Emma. I think my takeaway for everybody would be that the North American approach has been successful for many, many years. It's absolutely valid for Europe and elsewhere in the world. So let's go ahead and be bold. Let's explore the opportunities. Let's spread the knowledge and do some deals.
Jeff.
I would go along with Oliver's comments. I mean, we have enough data now. You don't have to take anybody's word for whether group captives work. We have data that can show you how they work. And so that shortens the learning curve. It shortens the trust level, or shortens the distance to have that trust level. So I would say it's definitely worth spending the time being educated on it, because it's just going to continue to grow.
Yeah. Josh?
I would say the customers that are out there, they need to take courage. They need to be entrepreneurial. It works in the US, and the company profiles that are part of group captives over there are no different from what we see in Europe. It just needs courage, and it needs an entrepreneurial mindset.
Yeah. And last but no means least, Dawn.
Yeah, so I would say I agree with everything that the other panelists have said. I do think also what I would encourage when you're thinking about and contemplating being bold in this space, if it's one that's not used very often, is listen to the needs of the customer and match that with the environment in which they're in the market, and providing a solution that helps to stabilize that experience for the customer really does prompt itself for at least the discussion around a group captive option. And so I think if we listen to that and we learn from some of the US experience, and we really try to find out how do we show up for that customer in the market and volatility that they may be experiencing, that group captive structure truly does become an attractive option and alternative for them.
Okay, thank you. And I think one of the takeaways for me as well is that I think there's a call to arms for the European captive industry to really promote this type of structure and try and reach out to companies that might be benefiting from it, bearing in mind that captives might not necessarily be on their radar. So we're bang on 4 o'clock on my watch. So thank you all for your time. Thank you to Captive Review for making this possible. We hope you found it useful and insightful. And I'd like to thank our speakers for sharing their insights. And of course, if you have any other further questions, do reach out to us. And as I mentioned, the slides will be available with full bios of the participants. So thanks again for your time, and I wish you a good rest of the day.
Thank you, everyone.
Thank you.
Thank you.